Ladies and gentlemen, good day and welcome to Varroc Engineering Limited Q1 FY23 earnings conference call hosted by Ambit Capital Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Nishad Vakil from Ambit Capital. Thank you, and over to you, ma'am.
Thank you, Nira. Good evening, everyone. We have with us Mr. Tarang Jain, Chairman and Managing Director, Mr. Christian Pascal, CEO, Varroc Lighting, Mr. Arjun Jain, Whole-Time Director, Mr. T.R. Srinivasan, Group CFO, and Mr. Bikash Duggar, Head Investor Relations. I now hand over to Mr. Tarang Jain. Over to you, sir. Thank you.
Yeah. Thank you, Nishad, for hosting the call, and good evening to everyone. I would like to thank all of you for joining the Q1 FY23 earnings call of Varroc Engineering Limited. Q1 of FY23 has started with a stable outlook for the Indian automotive sector on the back of the forecast of a normal monsoon. The growth is visible mainly due to the lower base of Q1 FY22, which was impacted by COVID wave 2. The semiconductor supply constraints continue to impact the premium two-wheeler production volumes, whereas the passenger vehicle manufacturers are seeing improvement in supplies. In India, automobile production for all the segments in Q1 FY23 rose on a year-on-year basis due to the lower base of last year, which was impacted by the COVID wave 2. On a sequential basis, two-wheeler production grew by 8.4%, but other segments fell on a quarter-on-quarter basis due to the cyclicity which we generally see from Q4 to Q1. Against this backdrop, we are focused on completing the divestment of our four-wheeler lighting business in Europe and America as per timeline. As stated earlier, this divestment will help the company to strengthen its balance sheet and invest in identified focus areas to drive future growth. In terms of operations, revenue from continued operations grew by more than 36.3% to rupees 16,283 million, despite our top customer production only rising by around 1% on a year-on-year basis. We continue to improve our profitability on a sequential basis as gross margin improved by more than 340 basis points. The EBITDA margin also improved by 210 basis points for the continued operations, and it came in at 8.2%. The operational PBT before joint venture for continued operations has become positive in the quarter, and it is rupees 138.3 million. The reported PBT was impacted negatively by mark-to-market on forex items of rupees 96.8 million and a JV loss of rupees 45 million. The reported PBT is negative of rupees 3.6 million. It is heartening to see that all the businesses within our continued operations have shown improvement in EBITDA margin on a sequential basis. The India operations EBITDA margin improved by 20 basis points to 9.9% in Q1 FY23. VLS remaining operations EBITDA margin improved by 290 basis points to 1.7% for the remaining businesses, which is mainly the forging business in Italy, which is IMES. The EBITDA margin improved by 1730 basis points and came in at 6.8%. We continue to have strong order wins for new business in Q1 FY23 across business units. This will enable us to continue to outperform the industry growth and in improving the profitability. During Q1 FY23, lifetime revenue from new order wins is rupees 14,673 million, and out of that, business wins from EV customers is rupees 4,837 million. Profitable business wins, appropriate capital allocation, sweating of our assets, commercialization of our R&D efforts, and control on costs remain the focus of the company. Mass production of traction motors, controllers, and the telematics shows the capability of the team to industrialize a new product first time right. The R&D team also developed the electronic fuel injection for an extreme customer in record time, and the production has started from June 22. Our effort remains to move to a double-digit EBITDA margin in the next 2 to 3 quarters. The focus on operating leverage and expansion in gross margin across businesses will help us in achieving the same. We remain committed to take the EBITDA margin to 12% and ROC above 20% over the medium term. In our financials, the business which we are divesting is now accounted as discontinued operations, and only the profit and loss from discontinued operations is shown as a one-line item in the income statement as per the accounting standards. Please also note that as per accounting standard 105, the assets which are held for sale cannot be depreciated. Thus, the depreciation for Q1 FY23 for discontinued operations was nil. Here also sequentially, we have seen improvement in the gross margin by 210 basis points in Q1 FY23 as compared to Q4 FY22. With this, I am now handing over the call to Mr. Srinivasan, our Group CFO, who will walk you through the presentation which is already uploaded in our website and also in the stock exchange.
Thanks, Tarang. Good evening, everyone. You already have the presentation with you, I presume, so I will just quickly touch upon the key points. Starting with the highlights for the quarter. So during the quarter, we started mass production for both traction motor and traction controller for our anchor customer, and the value of these two products put together is more than 15,000 rupees per vehicle. We also commercialized electronic fuel injection system for our largest customer in record time. Our R&D team was able to turn around this very quickly, which shows our technological capability. And so this will also lead to other businesses with the customer. So this is a big breakthrough for us. In spite of, let's say, the market growth, as well as the growth in volumes of our largest customer not being so robust, we still managed to record a 36% year-on-year growth in terms of revenues, which is quite predictable. As Tarang mentioned, the EBITDA of our continuing operations improved sequentially by 210 basis points to 8.2%. And during the quarter, we also won new business from various customers totaling to 14.7 billion rupees, out of which almost one-third of it was orders from 3 customers for EV three-wheelers, both EV-specific components and also other components like plastic parts, seats, and lighting, and so on. So it's very heartening that the share of EV business in our new wins is going up. It's almost one-third now in the last quarter. The second slide has overall industry performance, volume performance. So the growth you see year on year is mainly because Q1 last year was impacted by COVID wave 2, which is resulting in good growth numbers for this year. But if you look at sequentially, it's slightly different. Two-wheelers still recorded a good growth, but three-wheelers, passenger vehicle and commercial vehicles actually showed a decline, mainly because in Q4 typically there is an uptick in volume because of tax, to avoid tax depreciation. Many corporate customers postpone advance their purchases into Q4, so Q1 is comparatively slightly slow. That's why it is reflecting in that. So two-wheelers have started the year on a good note, which is very important for us as a segment. So we hope with the festival season and going forward, the growth momentum will pick up. In the next slide, you see a summary of the financials for continued operations. So you see revenue quarter on quarter was flat, but we were still able to improve EBITDA margin because our price realization improved in this quarter. That's mainly because, as we all know, there is a 1 quarter lag normally between the commodity price increase and the price increase we get from customers. So during the last quarter, commodity prices are more or less stable, but we got increases related to Q4 of last year. So that resulted in better margin. So that's why you see a better operational PBT. But during the quarter, we also recorded mark-to-market forex loss of about 9.6 crores because of the weakening of the euro on the intercompany loans given by us to the VLS business to support them for the liquidity requirement. In the previous quarter, it was a profit of 11.9. So it's a mark-to-market at the moment, it's notional. And the China JV had some challenges in the overall performance, so it's still at a loss. But because of the lockdown imposed in Shanghai and other places, the market volumes have not really picked up yet. But overall, at PBT level, we were kind of close to break even compared to the losses incurred in the last quarter and also last year. In the next slide, you will see the revenue breakdown in different dimensions. From a business unit perspective or a product perspective, PBU or plastic components form the largest part, accounting for more than 30% of the revenue. Lighting, which is a combination of four-wheeler lighting in India, two-wheeler lighting in India, as well as the global two-wheeler lighting business we have in Italy, Romania, and Vietnam, together accounted for almost 24%. Then electrical and electronic components in India was about 18%. Metallic components, which is transmission-related components and valves, together was about 12%. The aftermarket business, what we have mentioned in the earlier calls as well, is seeing a much faster growth, and the profitability margins there is also pretty good. So that has now reached almost 10% of revenue of continuing operations, which is a good sign, which is also helping in the overall margin improvement for the business. IMES, which is under others for our reporting, contributed 4.6%. On a segment, product segment basis, two and three-wheeler account for 63%, four-wheeler is 32%, almost one-third, and the rest is others. From a geographical perspective, India, with the continuing operations, accounts for 80%, and with 20% of the revenue coming from outside India. And from a customer perspective, Bajaj, on a total basis, contribute to more than one-third. In India, they are slightly above 50%, and the rest of the customers together are about two-thirds, or slightly less than two-thirds. In the next slide, we are trying to give a split of the performance between the different business units or segments we have. The India operations, which is basically the two-wheeler focused business, improved EBITDA margin from 9.7% to 9.9% instead of top line remaining kind of flat. The overseas operation remaining the part which we are not selling, which is a global two-wheeler lighting, electronics, and so on, and also the four-wheeler lighting business in India together improved the margin from EBITDA margin from a negative 1.2 to positive 1.7, so almost a 3% improvement. And the other operation, IMES, also witnessed a turnaround where we were able to pass on the commodity price increase as well as the energy cost increase to the customer. We got compensation prices that also improving the margins there. So overall, for the continuing operation, that resulted in 210 basis points margin improvement. Going a bit to net debt level, we have net debt remained kind of more or less constant over the last 3 quarters. So maintain this 27 million includes some advances we got from customer liquidity support as well as small amount. On a net debt basis, a lot of this debt is about 1,000 crores in India, the rest is abroad. The debt abroad will be fully repaid at closing, like we have communicated, and the debt in India will come down. That's the plan. On the next slide, we have given kind of some insights into the new order wins. The new order wins will contribute a revenue of let's say 212 crores in current year and 780 crores coming from the subsequent years. And if you split the orders between EV and IC IC vehicles. One-third of the new orders from EV vehicle manufacturers, and the balance two-thirds coming from IC manufacturers. Bajaj accounts for about one-third. The non-Bajaj is two-thirds, roughly in line with the revenue share. And the new order wins in the two and three-wheeler segment is about two-thirds, and the one-third is from four-wheeler, which is an encouraging sign because the share of four-wheelers in new business wins and revenue is going up, and four-wheeler typically has better margin structure than two and three-wheelers. Then the next 2-3 slides, we have tried to give you an insight into all the components we have available. We are able to offer to the customers from the specifically targeted EV segment. Some of this we had gone through in the previous quarters as well. The main highlight was the commercial production of traction motors and controllers, which started during the last quarter. And the following slide gives a status on the divestment. So we are on track to close the transaction by end of September. The shareholders' approval was received some time back. Lenders' approval is an ongoing exercise, but all lenders have expressed their support. So the documentation is in progress. From a regulatory perspective, we have got the regulatory approval in 3 out of the 4 geographies: UK, European Union, and Morocco. Mexico is a pending one, which is also expected to come through end of this month or early next month. So right now we are well placed to close the transaction end of September. The following slide gives a big overview of the financials of the discontinued operation breakup. So mainly you see the improvement is because of that we have stopped charging depreciation on the assets of the discontinued operation under Ind AS 105. So otherwise the performance is comparable to the previous quarter. So that's briefly a quick recap of the performance. Now you can go ahead with the questions.
So shall we open the floor for questions?
Yes.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Anyone who wishes to ask a question may press star and 1. The first question is from the line of Aditya Jhawar from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity, and congratulations on delivering resilient performance in challenging environment. My first question is on VLS. So, Srini mentioned that the transaction is expected to close in September. What about, the cash flows? By when see the cash flow coming to Varroc, and how much amount we have budgeted for cash burn, and is it, in line with our estimates? And, related question is that we also see that there would be a fundraise, of about to the tune of 500 crore. What would be the objective of this fundraise?
Okay, the fundraise part is purely an enabling resolution. So there's no specific plan to raise any funds at the moment. So typically, if we don't take the approval now, then the lead time to get approval at the time is more. We'll have to hold an EGM and all that stuff. That's why we are taking just an enabling thing. There's nothing more to it. From a cash flow perspective, the money of the escrow account and everything will come to us immediately. Net of loan repayments and so on. So we'll sometimes early October kind of time.
Oh, okay. My second question is on new order wins. So it is encouraging to see that we have one order for, on electric vehicle from other than our anchor customer. So for the two new customer other than our anchor, if you can highlight that what is the order win? Is it traditional product, existing product, or there are EV components?
These are our traditional product only, but the encouraging thing is that we have both incumbent as well as new customers on the EV side. So the new incumbent, new and both incumbent customers are there for our product. So we have started engaging with them for our EV product related. So sooner or later, we will get orders for those also.
Okay. Thanks, Vikas. Just wanted to check on one thing. So we also mentioned that, traction motor and controller for our anchor customer, we'll be ramping up production. But when we look at slide number 13, where we have quantified that, total revenue from EV could be at about 1,000 odd crore, here we don't see, mention of traction motor and controller.
No, it's mentioned out there, traction motors and controller.
No, so I mean the order that you have quantified 700 and 300 crore, it is not against traction motor and controller.
No, I think that is just a combined number.
Okay. Yeah, I think thanks a lot, Tarang. I think that's it from my side. In case any question, I'll fall back in queue. All the best.
Sure. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead. Ashutosh, may I request you to unmute your line from your side and go ahead with the question, please?
Yeah, hi. Am I audible now?
Yes.
Yes, sir.
So, firstly, if I look at this IMES operations where margins have improved YOY, Q1Q, while revenues have dropped. So, is this sustainable? What will happen over here?
Yeah, so the margins, more or less, we would like to sustain it because we have got some customer price increase of last year in related to the energy cost and the metal prices which have gone. Unlike in India where the pass-through happens on a quarterly basis, in Europe is on an annual basis, and now we have got that price increase, and we would like to sustain this kind of EBITDA margin and see that how can we utilize our capacity further to further bring the efficiency into that business.
No, but does this EBITDA also include some basically compensation for last year, or this is normal for this quarter only?
This is normal for this quarter.
Okay, so we did not get any compensation for last year.
Here, this is something which is normal now. It's a normal margin.
Okay, and secondly, so VLS remaining operations, they are also like a 1.7% margin this year, despite almost 50% higher revenue versus last year. So, how should we look at this business? How should the margins improve over here?
So see, these the revenues here are coming basically, from our lighting business, our two-wheeler lighting business abroad, which has got plants in Italy primarily and Vietnam, which continues to have a double-digit EBITDA. Our electronics business unit in Romania is on a ramp-up stage, and going forward, I think once it utilizes capacity, we will see, EBITDAs going up, up to probably, up to 8%. And this is something, which will mean also a PAT positive kind of a performance from the EBU. And this is something which should happen probably in the coming months. And thirdly is our VLS four-wheeler lighting business in India, which also I think we will see improved numbers. Here also our target is that in the coming quarters, few quarters, that we reach a double-digit EBITDA. So I think with all these together, I think going forward in the next quarters, we will be striving that we take this, EBITDA up closer to a double-digit kind of a number. We're talking about for the VLS remaining operations, which are going to be our continued operations.
Okay. And India, is there a possibility of margin improvement from here?
So we will be going up because we see our revenues increasing in the second quarter, right from July. So here we will be definitely at a double digit, a double digit EBITDA. And here, of course, like we have said before also, in the medium term, we will be reaching this 12% EBITDA.
Okay. Because the point is that despite this EBITDA improvement, because of higher depreciation charges that we have now in remaining operations still, I think at the PBT level, the margin is not very good. So depreciation also will increase going ahead. How should we look at it? Like, can the PBT margin improve significantly from here?
Yes. So for sure, because see here the way I see it is that the EBITDA margins are going to grow, across, and especially in the bigger businesses of India as well as the continued operation of VLS, we will see significantly improving margins. We will see that from a PBT point of view, we will see that our interest costs post the transaction will drastically reduce, which is quite high today. So that's something which we see, going down, kind of considerably. So therefore, we are looking at obviously a good, PBT performance, post, I think, the transaction, this thing happening. And here also, even in this June quarter, as you can see, we had a foreign exchange loss of about, 97 million, which also was the reason why we had a small loss of, 3.9 million rupees. 3.6 million rupees, for this quarter, otherwise we were actually a performance, a gross of that forex loss, was positive.
And lastly, I probably missed initial part of the call, but in terms of net debt after completion of transaction, how should we look at it? Like say considering whatever losses you're making right now in VLS discontinued operations.
So we have already mentioned earlier that we'll be net debt negative, So that is clear. So we are not. So we are going to be net debt negative, if we have to take, after repayment of all the loans, and also if we do not repay 100% loans because there's some working capital loans, we will have cash in the books, So we'll be net debt negative on the whole as a balance sheet.
Yeah, but will the cash be like say higher than 300-400 crores, or if we're just getting net cash position?
No, last time we had said that we'll be about 200 crore plus, but there will be a little bit of a cash burn because, that we do see, because of the inflationary conditions, in Europe. So that's something which will be there. So there will be some, adjustment. So probably a 200 could go down to 150 or, things like that. And so we have to see how things pan out. It's a question of another month, and a half. So it's not that long also at the moment. So we do see some this thing, but the main thing is that we'll be net debt negative. That's the main our statement. Little bit here or there is something we can experience, and we will come to know September end really, where we are. But we already know our situation, where we are today. And going forward, obviously the focus is going to be a lot on the India side because that is going to be our major revenues. And there we will see, and there we have a strong growth, potential going forward. We have a lot of business wins. And here, I mean, unlike probably maybe global markets, but in India, we continue to do, kind of well, and here we will see definitely, improving margins also as we go along.
Oh, thanks a lot.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for opportunity. Sir, what is your revenue guidance for the FY23 and 24?
So see, we have said, so we will be, like this year for our perimeter, we have said that, not counting China, because China is still in a JV, that we'll be at about 7,000 crores. And then we have said for the coming years, I mean, whatever the market growth is, we are going to be to 10% more than the market growth. So we're going to perform better than to 10%. So that is our guidance for the coming 3 years.
Okay. And BLS remaining operation, which revenue stands at around 3 billion on quarterly basis. So what is your outlook for the revenue and the margin going ahead? As you have mentioned that you are looking at margin of 8% versus the 1.3% right now. So what is the roadmap for there?
So there the roadmap is that we will reach, 8%, between 8 to 10% in the coming 2 to 3 quarters. We will achieve that, that percentage to EBITDA percentage to revenues.
And what would be the revenue size for FY23 from the BLS remaining operations?
So here, so India, I think we had said close to about 5,500 crores, and the balance without China was 1,500 crores. That's a breakup.
Okay. And the overall margin would be 10 to 11 for FY23.
Yeah, so double digit is what we are trying to push for.
Okay. And sir, currently four-wheeler contribution is around 33%. So what mix you are targeting going ahead? If you can throw some more light on the winning new business in the four-wheeler lighting system and other parts like in the polymer and metallic.
Yeah, so see, our focus is definitely when it comes to the India market, definitely we expect full growth in our India lighting, four-wheeler India lighting business, and also on the plastic side, the plastic interiors, where we do quite a few products. We have a lot of new technologies here, like 2K molding. We have some very unique parts like the roof rails, which are there for the SUVs in the growing SUV market. Here we are so both for lighting as well as for our plastic interiors business, we see a huge growth. And it will be a double-digit growth for in the car market on these two segments. Other than that, we are also looking at some of the transmission parts which are engine agnostic, even something to do with the EV, whether it's to do with shafts or there are other parts. So we are discussing with various customers on the export side, which is also higher margin business. And here we are looking at, of course, the domestic market, but also more importantly in the export market where our metallics is concerned. So probably going forward in the metallic side, we could in the coming years see a shift more towards, four-wheeler, as compared to the two-wheeler as we move along.
So recently you have won the business for the four-wheeler lighting system in India. I think it is for the Mahindra and for the Toyota. So if you can throw some more light on the winning new business in the lighting system, and what is your revenue right now from the lighting part only?
So India lighting business, you can say we will be 500 crore plus in revenues in this financial year. Our major customers in the four-wheeler lighting business today are the Volkswagen Group, Mahindra and Renault Nissan. These are three, and also Tata. Tata is smaller. So here we are, presently focusing on these customers. Of course, we are also looking at winning business with a few other four-wheelers where we are strongly engaged. So today, actually, frankly speaking, we are very well utilized in both our plants when it comes to both Pune being the larger plant, 80% and 20% in Chennai. And here we are very much engaged with our customers for future business wins. And like I said, in a lighting business also with these customers and a couple of other new customers, whom we are talking to, which I can't name at the moment, we are looking at a double-digit growth also in our lighting business going forward in India.
Thanks, sir. And sir, my last question is related with the capex plan for the next 2 years.
So I think that when it comes to India, I think we are going to be at probably approximately about 200 crores, or 2,000 million, rupees year on year. That's what we are looking at for the kind of growth I have mentioned, and abroad also there will be a certain level of investment for the continued operations, which also could be another probably, maximum, it could be about probably up to probably 50 crores or 500 million up to.
So 250 crore sort of the capex will be in the next 2 years, right, sir?
Yes. I mean per year.
Okay, per year.
Per year.
And as
investment, yeah.
And as you are targeting around 1,000 crores kind of the revenue by FY25 in the EV segment, so most probably the capex would be at the higher side to get this business. So
no, see, we have already created a lot of capacities in our electronics, factory on the SMT lines, and we also, have a good capacity on the motor side, But yes, I mean, what I'm talking about, the growth, even if it's for the EV side, it'll be within this investment. So it's not mostly. I think more of our investments will go more towards our plastics business and our electronics business. That's why we see major investments going. As we go along, it'll be relatively less. On the metallic side, we'll be leveraging more existing capacities to utilize the capacities better, including for the four-wheeler components in India or for exports. So we have still enough capacities available.
Okay, sir. And sir, after the closure the deal, so you are talking about that you will be the net cash company. So there won't be any date on the books, right, sir? I mean, from in India business as well.
On a net debt basis, yes. On a net debt basis, now we're not going to stop our working capital lines. The working capital line will be debt, but I'm just saying that will be to the extent cash available, in the system. But we're not going to eliminate all our working capital limits. That will continue.
Okay, and what would be the size of the working capital you would be required?
I mean, out of the, let's say we have a net debt of 20, the working capital, continued working capital. I think it's normally overall. I don't think it's going to be more than 300 crores or 400 crores. At the max, I'm saying on an overall basis.
Sir, adjustment between enterprise value.
No. This is on a continued basis. What is the working capital?
On a normal basis, typically our receivables are between 45 to 50 days. Our inventory levels in India is around 30 days on average, and payables are around 60 days. So that's the normal working capital cycle we have. So you can, I guess, do the math.
Okay, sir. Thank you, sir. That's all from my side.
Okay.
Thank you. Next question is from the line of Swan Investments from Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good evening everyone, and congrats for a good set of numbers. I just had 2-3 queries. One was you mentioned that while the net debt will be 200, net cash will be 200 crores post the transaction, the cash on the balance sheet will be little higher because you will have some short-term working capital there. So considering that normally, the yield that we get by putting it in treasury is normally lower than, what we pay on that, it's a negative carry. So do you have any plans, because you mentioned that capex is only 250 crores, which you may be able to fund from internal accruals. So this 400-500 crores of cash that will remain in the balance sheet post the transaction, what is the thought process?
No, I mean, that's something we will come out with some kind of a policy, I think probably.
First of all, last 3 years we have not paid any dividend. I think it is time that we pay out some dividend, give some cash back to shareholders. So we'll let assess based on the cash what we have. That's number one. And secondly, it's always a good idea to keep some liquidity in the balance sheet. We don't want to be cut in terms of the cash and the liquidity, which we have learned the hard way during the COVID time. I think some liquidity buffer, because you can never be sure what's around the corner, right, from the industry perspective, market perspective, economy perspective. So some contingency buffer is always good. So we'll evaluate, and so that detailed planning. The immediate focus is to now close the transaction so that we can move on with a strong balance sheet, and then we are parallelly working on our strategy 2030, which also we hope to be ready in the next 2 to 3 months. And then we'll have a clear roadmap of how we are going to deploy the, let's say, the capacity we have in the balance sheet to invest.
The line for the participant dropped. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Saurabh Jain from Ambit Capital. Please go ahead.
Hello.
Yes, Saurabh, go ahead. You're audible.
Yeah, sir, just wanted to understand about the industry outlook. So if you could shed some light on how is the demand right now in the industry. So do you see the demand coming back strong, or the uptick in the volumes is largely due to the pent-up demand? And also, if you could shed some light on the European demand scenario, given that we're seeing high inflation and other political headwinds over there. So any color on those fronts would be helpful.
So on the India side, we definitely see we definitely see a kind of a strong demand pull is there. Today, the limiting factor, frankly, is only the chips. And that I can say for the two-wheeler sector and even the four-wheeler sector. We see a strong demand, but whichever customers, if their volumes are down, is largely only because of the chips. And I see that in this year, provided the chips are available, for the various electronic products, I don't see really a problem in achieving a double-digit growth for the industry. So this I clearly feel. So even in the first quarter, if there were issues in the growth in volume, it was largely overall because of the chip shortage, not because of the demand. That's why going forward, we'll have to see how things pan out. But anyway, even in the coming years, I do feel that there will be a growth, in the Indian market, of at least 7-8%. This is the way I am quite optimistic about the market growth, going forward, both in the two-wheeler and the four-wheeler sector. We should not compare the India situation with the global situation. Is very different. We have our own, demographics here. We have our own situation here, which is quite positive. So irrespective of the issues, we have inflation in India also. Yes, it might affect a certain segment, but then overall, we do see a good growth, because there's a demand, and I think that the monsoons also this year are quite good, and this is also going to help, demand, in the coming season. We do see so I do see a good double-digit growth in this year in the remaining quarters. The first quarter was a little muted. Yes, there are chip shortages still there, but it's improving, So I do see, a good growth in the Indian market, which will be for us the major play. Where it comes to the European market, yes, I mean it is impacted, I would say, by the Ukraine war. But there and maybe Christian can also elaborate. I don't see really any softening of any volumes there or demand because of this. At the moment, at least I don't see it. Because but there is inflation, so there are cost pressures there. But I don't see really at the moment, a problem of demand, at least in this year, in spite of so many things, taking place, especially the war. Maybe Christian, you can maybe a little elaborate on the volumes, in Europe.
Yes, sure. So, but as you are saying, the global situation, especially in Europe, is as well depending on the chip shortages. We are improving here, but we have high inflation costs we have to absorb, and the OEM as well the war in the Ukraine is influencing.
Got it. And secondly, on the margins front, you did mention that we had a good 340 basis improvement on the gross margin front, and the primary reason, as you mentioned, was the inflation pass-through that we received in this quarter. But if you could, just help us out quantifying, as in how much of this 340 basis might be due to the pass-through effect, and have we seen any material improvement because of the correction in the commodity prices as well?
See, basically, as you know, we had got a overall 8-9% increase from January, of 22, from all customers. Now, in fact, what has happened is that, so that has of course resulted in, an improvement, in the gross margin. But in fact, a gross margin should have been better, than what we have actually achieved, so far. But the problem was that there has been an inflation, in the commodity prices, So there has been, so in spite of that, there was an improvement in gross margin. Otherwise, it could have been much better, in our view. And also after the gross margin, also there was an impact mainly because of some labor cost increases and importantly energy costs. They have gone up, quite a bit because of the war. And that is what resulted in, the kind of performance, in the VLS discontinued operations. So they have been a little bit impacted. But we're not seeing really a problem in the overall volume. The demand has still been there. It is just that, there has been, this, so the price increase which we're expecting, if there was no war, I think the performance would have been better. Because there has been not so much of inflation, which we're experiencing. But having said that, we have again asked some of our customers for some price increases from April, and we do expect a settlement of some price increases from April onwards in the month of September, because unfortunately August is a holiday period in Europe, and of course all our customers are also, the decision makers are also on leave at the moment.
And in India, the gross margin has also improved because of the internal efficiencies which we are trying to bring in the system, be it our sourcing, be it value addition, value engineering. So that we are continuously doing, and that we will continue to do for the rest of the year, so that our gross margins further improves from this level.
Yeah, understood. That's it from my all. That's all from my side. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The follow-up is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, just one question on the lighting part of the business. So if we both in four-wheeler and two-wheeler, if you could tell us, where do we stand in terms of the LED part of the lighting business? How do we see the market evolving, and what is the type of market share gains we are looking there in the next 2-3 years?
Yeah, maybe Arjun, you can answer that.
Yeah. So I think from a India specific standpoint, I think really today, if we look at whether on the two-wheeler lighting side or the four-wheeler lighting side, I think the premium segments of the market, I think we're doing very, very well. Now, when I say premium segments, what I really mean is, if you look at 250cc plus, where you really have full-fledged, Class D homologated headlamps. Today, we occupy all, Bajaj, KTM, all the other KTM brands as well also, and I think we do fairly, strong volume there. Even the new Pulsars that have launched, we supply the bifunctional LED module over there as well. From a passenger car standpoint, I think a lot of the new models that have launched over the last 12 months, especially the XUV700 and all the Skoda and VW models that have launched, we do a very large lighting. So XUV700, we do almost all the lights, that are on that vehicle. So, I think when we think about the technology that we already have on the road, I think it definitely places us in a very good position as more and more vehicles move towards LED. Right? Ultimately today we are fully localized, whether in terms of design, development, manufacturing. For these technologies, we're also vertically integrated with the electronics manufacturing, which is really around 50-60% of the BOM now. So we feel we're in a very competitive place, and I think that is really what we could leverage going forward.
You mentioned 3 customer names, so these are the only 3 ones right now we are working on LED, or are we also working with some newer clients, and hence the client addition could be, we could see some more client additions about 2 and 4-wheeler as we go ahead?
Okay, so if I talk about passenger car, our customer base is quite comprehensive. So I spoke about Mahindra and VW because they are the largest customers. But we also do LED, we also do LED headlamps and tail lamps for Renault Sun. So both Magnite and Kiger. We also have LED content with Tata, especially in terms of DRLs like on Harrier and Safari. We also have other non-LED businesses also with all of these customers, right? from a two-wheeler perspective, other than, let's say, we do Bajaj, KTM, Ducati, Hero. So, we truly have a very comprehensive customer portfolio across technology segments. The question was more specifically about LED, so I spoke more about the customers where we're supplying high-end LED products.
Can you, sir, share your market share LED in two-wheeler and four-wheeler, and how do you see that in the next 3 years?
So honestly, I would not know it off the top of my head. Again, I think when we think about the LED market, I would definitely say that.
Are we in the top 2 or top 3 players, sir, or we think how many players are there? If you can get, and how are we positioned? If not a specific market share, we are number 2, number 3, number 4 in LED lighting today in both two and four-wheeler.
So I think two-wheeler, especially if we're thinking about it from a value perspective rather than a volume perspective, I would say we're definitely in the top 3.
Mm-hmm.
Passenger car, I think there is basically 5 suppliers, right? So I would say we're in the top 5. The exact number, I would not know off the top of my head right now.
Okay. But do we have any aspirations, do we have internal budgets where we are looking at some significant market share gains in this segment, LED 2 and four-wheeler segment?
So, I think for us, again, I will repeat, right? I think we are in a good place because we have been an early entrant and a market leader in terms of bringing this technology to the Indian market, right? And I think when we look forward, we would expect that customers will trust a supplier who has already done it rather than a supplier who is hoping to do it, right? So I think that is a trend that we hope to, the fact that we have product on the road, the fact that, whether you read, any, magazines like Auto Car or Overdrive, etc., all the lights we supply are being reviewed extremely, extremely well. So, and further, whether from a performance standpoint, reliability standpoint, again, we're doing really well. So the expectation is that is a trend we will be able to capitalize on further.
Sure. My second question is regarding the overall evolving of the auto ancillary architecture in India and globally. As we see the world ahead, it is becoming more and more about engineering, technology, software, and hence it has also become imperative for all the auto ancillaries to spend a significant portion of their revenues on R&D and innovation. So where are we in that journey today? How much do we spend or intend to spend on R&D and innovation as a percentage of sales or absolute number, and how many engineers we have on that, and how do we see that number in the next 2 to 3 years?
Should I take this also, or?
Yeah.
Okay, so I think whether I can speak more specifically about India, and I think anybody else on the call can also add about the rest of the world and the continuous perimeter. But I think in terms of engineering, I think really as Varroc, we have always spent on engineering. It's not a new thing, right? We've always been self-sufficient when it comes to technology. So almost all the products that you see on the road, all the products that we supply is technology that we have developed and driven ourselves. Now, of course, over the last few years, whether as a result of BS6 and topics like fuel injection coming to two-wheeler and also now with EV, I mean there has been a need to drive further investment. But in my view, I think we've already done that. We had a lot of analysts come visit our tech centers. I think maybe last month or the month before, and I think we're able to demonstrate comprehensive product development capability. Right, and so in a lot of ways, it's investment that's already been driven. Of course, as technology continues to evolve, we will stay with it, right? Because for our customers, ultimately, we are the supplier, and I think both our CFO and our CMD talked about how we were able to ramp up a fuel injection system in 3 months, right? And we supply 50,000 sets a month now. So, I think definitely, I think the technology capability is something that, we've always had, we've built on further, and something that, I think our customers recognize also.
That's fair, but can you give, I was looking more for some, numbers per se. If you could tell number of engineers we have in R&D innovation, and how much do we spend yearly, and what is the intent next 2 years? That would be more helpful.
So, number of engineers today, I would say the engineering center for electronics alone would be somewhere around 450. I think if we look globally, I think we will, in the continuous perimeter, have approximately 750 engineers. In terms of the total R&D spend, I would not know that number on the top of my head.
It will be about 2%. I think in our perimeter now it will be around 2 to 2.5% of revenue.
and we intend to keep it there. We intend to increase it as a percentage of revenue going ahead.
We don't need to increase it. I think this is enough.
Sure. Thank you.
Thank you very much. I now hand the conference over to the management for closing comments.
So I just want to thank all of you again, for joining in, listening to us and asking your various questions. The trust and faith of our stakeholders is what motivates us to pursue excellence in our day-to-day life. So thank you very much.
Thank you very much. On behalf of Ambit Capital Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.